Hello, this is Brian Akers. Welcome to our classroom session for February the 11th of 2021. Today we have a special guest. That's Daniel WIldermuth from Kalos Financial. Kalos Financial, he is a Chief Investment Officer and CEO of Kalos Financial, and also the WIldermuth Advisory. He's the Chief Manager and the Portfolio Manager and also the head of that company also. So he runs a mutual fund called the WIldermuth Endowment Fund. And for many of our clients, he has managed the WIldermuth Dividend Stock Growth Fund for many, many years. We at Akers Financial Group, we started our company back in 2006. And many of you know that that's when myself, Jeff, and a couple others joined Kalos Capital as our broker-dealer. They're our broker-dealer and our RIA, our Registered Investment Advisory Company that we work through. And we chose Daniel WIldermuth to be one of our money managers since the very, very beginning. Daniel's a brilliant guy who has graduated from UCLA and Stanford, and has been managing money since 1997 here in the States. He managed money in Hong Kong prior to that. Him and his wife, Carol WIldermuth, run Kalos Financial, and they've done a great job helping our clients throughout the many years we've worked with them, which is 15 already. It's gone very, very quickly. We do thank you for listening and paying attention to our talk today. Daniel WIldermuth, we've asked him to come and talk about the markets, what's going on, what's been going on, and what he thinks is going to happen here in the future. For all those listening today, we do have a special gift for you. Kim Hates put together a very nice blanket, the Akers Financial Cozy Blanket. This is yours for listening. If there's a fight at the household between you and your spouse, feel free to ask him if we have an extra one or not. After the first seminar back in January, we gave away many of them, but we have a few more left, so feel free to ask for one of these. At Akers Financial Group, we do a lot of things to try to get information out to our clients and for those that are checking us out. The webinars are designed where every 2 weeks on a Thursday at 4 p.m., we have a live showing of our webinar. Then the webinar goes onto our website as a source of information for the future that you can access through the site just by signing up. So akersfinancial.com is the website that you can access this through into the future, and you can see this again and again. If you'd like to have it forwarded to anybody you know, please give us a call or an email at info@akersfinancial.com, and we get information out to them. Akers Financial Group welcomes you to our show today. We also like to invite you to our radio show. Our radio show is called Winning in Retirement. It's on Saturday morning. I'm the host of it. And I bring experts on to join me, such as Jeff Akers and Alex Monk, Mark Dorio, Daniel WIldermuth, and a few others. Akers Financial Group's been doing the radio show for about 4 years now. We changed the name to Winning in Retirement to more focus on the concept of how to win in retirement. And that's how we use all of our financial planning advice, skills, and the process that we do at Akers Financial to bring the proper advice that someone needs to make sure they're always winning in retirement. That's on Saturday mornings at 11 a.m. on 105.7 The Fan. You can find that through radio, normal radio, or you can go through the internet, 105.7 The Fan. You can also go to radio.com and listen through that app off your phone anywhere in the country on Saturday mornings at 11 a.m. East Coast time. All right, so our webinar today is Daniel WIldermuth from Kalos Financial. We welcome him, and we ask you to just get ready to take some notes and enjoy Daniel WIldermuth.
Well, hello, everyone. It's great to be with you today and be able to talk about some of the factors that are likely to impact the markets in the near future and the longer term as well. As you can imagine, as my role as CEO of Kalos Financial and WIldermuth Advisory, I spend a lot of time thinking about those things and just thinking about how they're going to impact markets and how they're going to impact other asset values as well. So with that, I'll go ahead and share my screen here, and then we'll get started. So with that, again, my name is Daniel WIldermuth, and great to be with you. And we'll go ahead and start with the first slide. COVID has obviously wreaked havoc in so many areas of our lives, and just continues to keep on giving in so many ways. It certainly is the primary driver of the markets in the short term, and some of it has to do with our perception of how the economy is recovering, how it's changing, how it's morphing. is impacting a lot of that. Are we proceeding according to the plan, whatever the plan is perceived to be? Some of that is related to are the vaccines rolling out appropriately? How are different government offices reacting? How is business supporting and reacting to it? And then along with that, what is the additional government support that is expected to come or actually does come? The Biden plan being discussed at this point is very significant. It's fairly large, and parts of it are expected to pass easily. Parts of it are already passed. Other parts that they're trying to put in place likely will have a larger impact. But there's also concerns that some of that plan is likely, dare say, political. It's not particularly attached to what's happening with COVID, but it's an attempt to push a particular agenda. That agenda may be fine. It may not be. It depends on kind of your perspective. But a lot of it is somewhat extraneous to the actual needs right now for COVID. And how much they push through and how much they attach is going to affect how quickly it gets passed and how quickly it makes an impact. Some of it has to do with the state support and some of the additional support that is put in there to particularly help the blue states. And that's going to be controversial, but it's going to impact how quickly that plan gets rolled out. Also, of course, looking at the working environment for people, home versus office, how much does that adjust over time? Working from home for many people has opened up a lot of different possibilities. You've got a lot of different jobs that probably won't go back into an office, but you've got others that will. I know for our office, we've been open since May 4th of last year. We're based in Florida, so we haven't had a lot of the shutdowns that other states have had. But if you're in California or Washington, D.C. or New York, or many other parts of the country, you've been largely shut down and prevented from going about businesses as would be normal. Certainly nothing is kind of normal anywhere, but it can be more normal in some areas versus others. That working environment and what we go back to is going to impact things, and kind of when do we go back? Do we go back at the end of first quarter, which seems at this point highly optimistic. We could be back at second quarter though, could be third quarter, could even be into 2022. So what happens with those things and what is the new normal is going to impact how quickly different things adjust and bounce back. And with that, the pace of readjustment and how much do earnings bounce back, that's a big part of it. And that's the big thing that is driving the market, is what do earnings eventually do? We'll see a little bit later on that the big 10 companies in the S&P 500 have grown to a much larger percentage than what they have been. And so much that has been based on the fact that their earnings have not been impacted, and in many places actually been helped by the shutdown, and are likely to continue to be helped, but possibly less so in a post-COVID world. And we'll talk about that a little bit. The vaccination path, this I got from Fidelity actually. This was their trajectory of the herd immunity being developed over time. This was developed as of the beginning of January, so it's likely shifted a little bit. And given how the vaccines have rolled out, it's likely shifted back a little bit. So it likely, instead of crossing, looks like the beginning of July or late June there, it probably is pushed back into July or potentially August. Again, this is what is going to impact potentially how much people are comfortable moving around, how much they're comfortable going back to normal life, and how much is still outstanding in different areas. So, some of the challenges with this are the overall herd immunity doesn't return by midsummer by almost any estimation. I was listening the other day to the radio, and they were talking about concerts starting up again in May. And at that point, talking about full concerts, no social distancing, and no face masks. That seems very, very unlikely at this point. Fauci was talking about the person who's been very public about a lot of the announcements with the overall COVID situation. He was saying that he thought concerts could go back, but he thought it would be possibly August. I think today people are a little bit less optimistic that we may even hit the August number. But who knows? We'll see how it continues to unfold. Moving from COVID more to earnings per share, and this is something that kind of runs through the major factor that really impacts markets. So we'll see on that if you look at kind of the overall impact on earnings, 19 and 20, 19 saw a little bit of growth over 18, 20 saw obviously a recline or a decline from earnings. And now back in 21, we've got a 6% higher than we were in 2019. And yet the stock market is dramatically higher. We've got 2022, I think, is really what people are looking towards longer in the future. That sees certainly a higher increase. That comes, though, with several assumptions, obviously. The first is that we don't have a significant tax increase, which at this point seems unlikely. It's certainly possible, but that's one of the things the Biden administration has very much promised and seems very likely to deliver on. And if a tax increase comes out and really impacts the earnings, that was part of what drove the earnings up during the Trump administration, and is likely what drives them back or potentially down, or doesn't hit, maybe not increase as much. But that's a certain significant negative impact that could significantly impact earnings and ultimately the level of the stock market. So that's something that is definitely worth watching, and because it will impact overall levels of stocks. And there's another piece that talks about a different category. This is talking about savings rate. You see the savings rate jumped up dramatically with the start of COVID. So the flip side is earnings may jump significantly, but they're kind of where they come from and where they jump from is a bit of a question. So here we've got earnings in people's pockets, and once they can spend it, they likely will spend it, but do they spend it on restaurants? Where do they spend it? Right now there's been a lot of money spent on electronics, which we see in a lot of the numbers borne out by the top companies. A lot of top companies are Google, Apple, Microsoft, companies that have benefited from the shutdown. Afterwards, my guess is that people aren't spending as much money on those companies. They're instead spending it in other areas of life, things that don't necessarily prop up corporate earnings as dramatically. So, it's not a factor that people aren't making money or don't have it. They're just spending it in particular areas that would benefit a few particular companies that have been extremely influential in the market. And that is likely to stop or at least change once COVID restrictions go away. So here's the major story, I would say, in the valuations for stocks. We've got a forward PE ratio, which is high, and there's just no other way to say it. We're back to effectively rates that we saw in late 90s, and we're back at levels that just haven't been seen more than, we've seen them only two other times. One was 1999, the other was 1929. And at that time, crash followed every time. And that is something that is certainly very possible at this point. It may be a little less likely because interest rates are so low, driving money from bonds into stocks, but there's no kind of way around it. The PE ratio is very high, and it's actually gone, this is the end of 2020. If we were to go into today, we'd see that bubble up just a little bit more. It's gone up a little bit more here at the beginning of 2021. Looking at it from what that does to potential returns over a long-term time period, and we see that that impacts returns fairly adversely. You see that the returns, when the PE ratios are this high, don't tend to be very strong in a single year. They actually tend to be negative in a 5-year total return pattern. So we're looking at a potential return on the stock market over the next 5 and 10 years that could be quite low. Now, it could be higher, but my guess is that it's going to be significantly lower. Part of what has driven, if we go back to the previous term, part of what drove the market up so much from 2008 is we see a market in 2008 that was very low in terms of the average PE ratio and has grown to be on the very much the high side. So we saw a growth in earnings, but we also saw a tremendous growth in the amount that we're willing to pay for a given level of earnings. So in, kind of take an average number in 2008, 2009, we were maybe somewhere around 14 times the current PE ratio. And now you figure 50% of that growth has come from the PE ratio growing up to over 22. And that tends to obviously drive markets up, but it's something that can't continue indefinitely. So, at this point we're very high. We could certainly see, a significant correction here in the near term, but don't know really when that is. This is simply saying that the market return expectation not particularly high on an average. So something to watch out for. This is a significant chart that shows effectively where we are today. So the top 10 holdings in the S&P 500, the top 10 securities in the S&P 500, you see them, they have a current S&P or current PE ratio of 33.3. And this is at the end of last year. And you look at that versus the average top 10 earnings, or up to 10 holdings have an average of 19.4. They typically are relatively high, versus the total market. But today they're extraordinarily high. You look at the remaining stocks at 19.7 today versus an average of 15.5. And again, those are high as well, but they're not nearly as high as the top 10 holdings. And you can see the top 10 holdings down in the footnotes. There's a list of who they are. They're Apple, Microsoft, Amazon, Tesla, Google, Berkshire, and some other companies. But the top ones, really the top 5, are all in the tech sector. And these companies have enjoyed tremendous growth during the slowdown. However, their earnings have far outstripped, their stock prices have far outstripped their actual earnings. So overall, the companies are doing extremely well, but the stock price has done much, much better. One that's kind of, potentially symptomatic of that is Tesla. Tesla has a PE ratio that's over 1,300. And it's kind of, okay, they could grow into that. That seems a little unlikely. That stock has gone up tremendously over the last year. And just continues to go up. There's been many short sellers and people basically selling the market short or betting against it who have lost their shirt with that market continuing to go up, with the stock price of that continuing to rise and rise. Within that, though, part of the challenge of this is these companies are not the companies that were hurt during COVID. So these companies have all been doing extremely well during COVID and are likely to lose at least some of their tailwind when we come out of COVID, or potentially face even a little bit of headwinds. And it's not that people are going to abandon Apple or Microsoft or Google. They're not going to dramatically change their behavior, but it's likely that they go back to spending their money as they were before, and the emphasis on technology, again, shifts to emphasis in other areas. And that likely doesn't bode particularly well for their earnings. It's not a tremendous headwind, but they lose their tailwind. In addition, the overall PE ratio level there is extraordinarily high. And if their earnings slow down at all and the PE ratio returns at all to normal, we've got kind of a recipe for a significant pullback. Now, the remaining stocks are also similarly high as well. Some of those, though, could be said to result from those companies having a pullback in earnings or an earnings recession, effectively. And not all of them by any means, but some of them, you look at airlines and hotels and some of those industries, they've had a significant pullback on their stocks. The challenge is airlines make up about 1% of the overall market. Hotels are a significantly smaller percent. So, we've got certain areas that could see a significant pickup in earnings, and would make those earnings look a little bit cheaper. But they're such a small part of the market that likely wouldn't drive any overall particular areas. So, that's a bit of a challenge. And just, it's basically the current versus the average is significantly kind of just out of whack, a technical term. You could see easily, you look at the current S&P 500 at 22.3 versus the average at 16.2, you could see potentially, 30 to 40% pullback, and you just get average. So, could that happen? I would say absolutely. I read a quote recently from Jeremy Grantham. He's somebody who is certainly well respected on the market and doesn't necessarily come out and say a lot of things, but he basically said that we're going to see, potentially a little bit more money go out on the table. There's still an opportunity to put some money out there and make something, but he thinks that in the next few months, we're very likely to see a significant pullback. And he may be right, he may not be. But I think there's just the likelihood that we see significant pullback continues to grow with the market valuations continue to remain so high. This is one that kind of also, you look at the 10-year annualized at the top, but one that's particularly interesting is since the market peak in February of 2020, you look at what value versus growth has done. And this is from February 2020 through the end of last year. And value, did okay, but growth did incredibly well. And that's very unusual. Value tends to outperform growth, but we've seen during the last decade or more that value has underperformed growth, and significantly as well. You look at the 10-year above it in that chart, look at what value did. Large cap value did 10.5% annualized. That appears to be pretty good. But then you compare it to growth, and growth did 17.2, and that's compounded. That would be more than double what value did by the time you actually look at the numbers. Looking at it another way, the current PE ratio as a percentage of its 20-year average PE ratio, and we see that every single category is above. It's above the average. And the value, a large cap valued 130%, that's above, but you look at one of the small cap growth at effectively double its average PE ratio. That could remain high for a significant time period, particularly with interest rates so low, but it seems unlikely to continue to, it just can't keep going up indefinitely. And at some point we are going to see a significant pullback and a return to normalcy. So, when does that happen? Who knows? But the likelihood that we see a significant pullback in some area is simply significantly higher than it has been really at any other time in this bull market. And part of that comes from as well that the government has we've got a significant shift in our current government. And by no means saying that the current administration is going to force a pullback, but their priorities are not, I would say, are not necessarily focused on the traditional middle, Main Street America. You look at the initial things that Biden did when he came in, and he basically canceled the Keystone pipeline, and you can make arguments on that plus or minus. It's more that was the first thing he did. And that was his focus, is effectively on green energy. And there's various other things that are focused on green energy. And you can argue that's good or bad, but it's not particularly an area that is going to help create a lot of long-term jobs in the United States. There's other things that are also very focused on initiatives that are not geared around helping the economy and will actually slow it down. And again, you can kind of argue, is that good or is it bad? It's more that it just is. And this administration isn't as focused on helping the economy as the last one was. And if you add in tax impact in that as well, we've got an administration that potentially may not be as friendly towards the stock market. This is one that is a little bit, it's got a lot of information on it, and I'll run through it with you quickly. So the first chart on the left there shows the growth in working age population. And you see that growth in working age population dropped from 2010 and 2010 to 2019, and it's predicted to drop even more over the next 10 years. And you translate that over to the chart on the right, the drivers of GDP growth, and you see that the growth in workers was a major drive of the overall productivity over the last decade. And that contrasts with the previous decade. And the reason for that is, I don't know if you remember, at the end of 2008, 2009, some people were out of work, that the growth in workers, that was a very kind of distorted viewpoint at that point, because we had a lot of workers who were not able to find jobs. Unemployment was still very high at that point, and we had a slowdown in the economy that still hadn't really recovered. So we saw a lot of that recovery start to take place in 2010 to 2020, 2019 essentially, and that's where a lot of that came out. That's where the 1.4% comes from the growth of workers. The 0.9%, looking at that on the far right bar, comes in the growth in real output per worker. So that was decent productivity gains. It's not what it was in the 1950s or 1960s, or even in the 1990s, but it was relatively strong. Some of the challenge on this, though, is then looking at 2020 to 2029, and we've got a more muted forecast for the growth of general population, and we've got a kind of a question mark out here is, well, what happens to the growth in real output? I think from 2010 to 2019, that 1.4% in growth in workers, that came from recovering out of the 2008 financial caused crisis. And with that recovering, we're not going to have a similar recovery on that. So we're not going to see a boost that basically, because we didn't, the 2020 was after 2019, obviously. And we saw that growth, the recovery of workers on that didn't happen. So that was in 2019, so it's in the next bar. And in that growth of workers, it's just going to be smaller. And similar, the growth in real output per worker, how much does that grow? That's kind of a who knows. It's been fairly constant for a number of years. Some people have argued that the technologies could give us greater output for a real worker. Other people have argued that it's fairly constant. But I think it's unlikely that we hit the 2.3% that we saw from 2010 to 2019. It seems most people have projected that continues to shrink, and it's a possibility, and it's something that we kind of have to deal with, and that's kind of on top of the other things where I was talking about in terms of valuations going into this decade quite high, and where we go for the next 5 to 10 years, and that's kind of a big question mark, but I would suggest is not particularly positive. So with government, we have Georgia elections. The Georgia elections came out with the government is no longer divided. So we've got a Democratic government with the House, the President, and the Senate all being Democrats. And it's a tight margin of kind of advantage for them, in that they don't have the ability to just kind of ram anything through. They have to satisfy all their own people, particularly in the Senate. But it is a party that does have the ability to effectively force things through. And that has generally not been a good thing for government. It simply hasn't. You tend to get bad legislation that way, and it tends to be true on either side. You tend to get things rammed through that aren't particularly good because you don't get the other side's input into them. You look going back 30, 40 years ago, when we had major legislation that was passed, it always had the input of the other party. You might not have had a lot of them providing input, but you had enough that you got input from the other party. Now we've got a situation where we don't have government divided. We've had that a couple times over the last couple decades now, and we just haven't seen good government come out. Obamacare is kind of an example of that, and you can say whether or not you can kind of make a judgment on that. But I think most people would say that wasn't the best piece of legislation that came out that could have been substantially improved. We could see other things come out of this that are possibly better, possibly don't have that issue, but it probably is not so positive for the overall legislation that comes out. Government resources, there's certainly a lot of borrowing that is going on right now, and the government resources are being tapped. Our government has a tremendous amount of resources they can use and add, and they are doing that. There's a bit of a question, though, about if we have a slowdown at some point, and the government does need to come in and try to prop it up, or we go into recession or something. At this point, the government can't really lower interest rates at all to spur the economy. So there is a bit of a concern that the government's kind of run out of different tricks they can use to keep the economy going. And that's fine as long as we're moving okay. But if we have a slowdown or some other challenges, they don't have as many tools in their toolkit to use. The government borrowing, I would say that some people see it's a big issue and say it's possibly an issue, but it's a longer term issue. It's not going to be a major issue for us. Inflation could be coming, but it's going to be after 21. It's going to be after, we've got a number of years before it becomes a significant issue. And, I recognize that that's maybe not the most popular thing to say, but it's something that has proven to be the case. We also are the only currency that is effectively based on the dollar. And with that, it gives us a tremendous amount of ability to print dollars, and we can inflate our way out of it. And that's not a particularly positive thing. We could lose our status as the global currency, but we do have that as an ability to basically bail ourselves out. And so money is very cheap, and it will be for a while. So this is something that I think people will get used to. It's already been a factor for a significant amount of time period, but money is inexpensive, and it's not going to change, at least in the near term. It could in the longer term, but not for the next probably 3 to 5 years. So it's a positive for us, but it could be an issue that becomes more of a challenge at some point as interest rates possibly start to creep up once we get to 22, 23, possibly a little bit later. The federal outstanding debt, this is, we see that it's obviously been climbing and climbing. It saw a significant increase in 2020, and we're now at the level that we've only seen during wartime, or in in the very post-war time period. And so for us, that's something we've been here before. It's more of a challenge is what do we do to get out of it? Taxes were so much lower in 1945 than they are today, and the government was so much smaller. So today, we're not going to see at least I'd be very surprised if we were to see a downward spiral in the debt over the next few years. Instead, I think it's much more likely that we see debt continue to climb. I think that line there is probably optimistic. It doesn't include Biden's debt plan. It doesn't include other things that the government is spending money on. So I expect that will be higher. And again, this is not necessarily saying that it's a disaster, but it is saying that we're getting less and less possibilities in terms of ways that the government continue to fight against different possibilities. So again, possibly an issue, may or may not be, but it's something to consider. Inflation expectations, they're just on the floor. Inflation is simply not expected to be much of a consideration over the next 5 to 10 years. And that could certainly change. If it does, that would be a significant impact on markets. It's not really something that it's expected to significantly change. So without going into it, I think that's a very accurate projection. It is possible that inflation does start to edge up, but I think inflation stays pretty low and we end up with this low rate environment for a significant period in the future. Again, not a bad thing, but something that is a definite plus for us. This is another way of looking at, going back historically and looking at inflation. We've had fairly low inflation since the 90s. So we've seen it bounce just a little bit, but it's been very constant for 30 years. There's no reason, I think, to really suspect that it changes significantly during the next decade. And this is something that inflation has been largely tamed and is sitting pretty well. Looking at something possibly related to inflation, though, and this is related a little bit to our printing as much money as we have recently and all the splurging by the government to try to help people. Return to post, the further weakening of the dollar is very likely. The dollar was very strong through much of 2020, but certainly towards the end of the year, we saw the dollar starting to fall, and we've seen the dollar continue to lose money. And I think the return to a post-COVID world likely continues that. So it's not just COVID that drove the dollar up, but we've spent money. Other people have as well. But I think the dollar is likely to continue to go down. All advanced economies have slashed their rates, and it's likely the strong dollar cycle is simply ending. The risk, this does mean that risk should likely shift more to emerging and developed markets. And I would say particularly emerging markets. Emerging markets have had a significant period where they've underperformed. And it's been because over the last 10 to 15 years, it's really been almost even like 20 years at this point, emerging market currencies have done so poorly versus the dollar. And as their currencies start to recover and possibly revert back to a norm, which they have been more recently, we likely get a tailwind of the emerging markets. So I think we've got a fair number of advantages to emerging markets. Their valuations are lower than ours are, and they'll likely have a tailwind of a weakening dollar. So both of those things likely contribute to strength overseas and potentially just their markets doing better than ours. Long-term debt, this is pretty obvious, and I won't really spend too much time. It's more that the overall interest rates have been very low for a significant time period, but they've been very, very low even more recently. And I know several times during the last several years, I thought that interest rates simply couldn't go lower. And I think we probably hit that low. I forget when it was last year, but I think we hit about 0.38 in terms of interest rates. So we've actually gone up to 0.93, but we're kind of on the floor at this point. And from 1981, with the interest rates being at a high, we've seen a tremendous bull market in bonds. So we've gone through 40 years where bonds have done incredibly well. We're simply done with that. The bonds cannot, they may provide a safe place or a safer place than equities, but they're simply not going to provide any significant return. You can go into junk bonds or other things. Fixed income is simply not going to be the asset class it has been for the last 10 to 12 years or even longer. So we're not going to see a tremendous return to bonds, a significant holder of value, which impacts a 60-40 plan because 40% of your assets are in bonds, which are going to have effectively no real return over the next couple of years. They're going to basically not even keep pace with inflation. And that is just reality. We're going to have to come up with other substitutes for those fixed incomes. So we look at fixed income, and I think in this year, cash is actually likely to outperform treasury bonds, meaning that treasury bonds don't even keep pace with cash and likely end up in the negative on the year. It does mean fixed income is likely losing its appeal. It does benefit, like I said, equities, because you have to take some money out of fixed income and puts it into equities. People want to take more risk at that point. It likely is contributing to current high equity valuations. That has been true for a significant time period, but it certainly has picked up speed more recently. With that, though, there's a bit of a question that it's contributed to current high equity valuations. With interest rates so low and having been so low for a significant time period, how much dollars continue to move from fixed income and into equities? And that's another bit of a question that it hasn't necessarily been answered, but it does kind of lead you to question, well, what happens with future valuations? Do we have, are there other things that can continue to drive prices even higher? Is it already gone as high as it can go? Again, those are questions that are potentially significant. Challenges to the 60-40 portfolio, meaning 60% stocks and 40% bonds. The number one thing is valuations. Fixed income doesn't really have a lot of upside, likely a downside, and valuations for equities are simply very, very high. Forbes, JP Morgan, and various others, I just picked those two, project 1 to 3 years % returns for the next decade. That could be 15% this year, it could be negative this year, but it does, it's simply a low return for the next decade. Returns could look better than that. They certainly could. But you've got a fair number of people, and these are, and again, it's Forbes, JP Morgan, but there's various other firms that have all basically said that projections are simply not going to be that high. We're not going to have great returns over the next decade. With that happening, that does suggest that some other asset classes could become more important, or you could simply kind of ride it out, hope for the best, or make some changes at the margin. So you can make changes a little bit into other things, and that can be in either private markets or other things. Forbes, read an article in Forbes, and this was the article that said gave the 1 to 3% projections. They had a different asset class that suggested a certain amount going into hedge funds and other alternatives, and a certain amount going into gold. And I'm not necessarily suggesting that, but people are looking at what are other places that I can make money outside of traditional stocks and bonds. 1999 and the year 2020 had significant similarities. On the stock market, there was a significant amount of dollars that went into SPACs. Those are special purpose, I forget the name of them. I forget what it stands for. They're special purpose vehicles that are raised to invest in other things, but you're not actually investing in a company. You're giving somebody else money to go do something that they haven't done yet. So you're not spending money on a particular company. The highest amount was raised in SPACs in 2020 since 1999. So last year was a record for IPOs, but it wouldn't have been without the SPACs. And in fact, it wouldn't have been, if you just took SPACs out of IPOs in general, it would have been a high year, but there would have been several years that would have been higher than last year. Another thing that's also contributing to high valuations is that companies that are losing money are again drawing significantly higher valuations than they have during the past 20 years. This was similar to 1999, where a lot of companies that were losing money had attracted high valuations. In last year and now, it's not as true as it was in 1999, but it is a similar phenomenon that we haven't seen for 20 years. It's something to be a little bit cautious of. We're starting to see things that look very much like the bubble of 1999. And contributing to that have been individual investors. Individual investors are a significantly larger percentage of the market than they have been for us, basically for the last 10 to 20 years. As they've moved into the market, we see different things happening. GameStop, I don't know if you saw that a week or two ago, and all the different things that individual investors were doing, where they basically were manipulating markets and drove some short sellers kind of into the ground. It's very unusual, but individual investors now have much more trading power and they're getting more sophisticated as well. but they're also at this point driving valuations up. And particularly you see it in the big tech companies and the companies that are the large companies that trade. And question is, what is their next move? Do they stay with this? Is it something that's simply born out of COVID, where people went to do trading as opposed to sports gambling or other things? Is it something that they exit the market at some point? And when does it happen? It may never happen. But I would suggest that individual investors are not going to stay with the market indefinitely, especially if we start to see more of a crash or some other challenges with the market. So I think individual investors are a definite wild card within the overall stock market and sort of seeing how it goes. Just some projections for 2021. I think stocks likely finish the year higher, but do fail to keep pace with the strong earnings growth. However, I will say that this, and I think this is significant probability, and I think it's potentially as much as 50%. I think stocks are set up for a significant correction. So I think stocks likely continue to go on, but I think at any time we're getting to the point where stocks could go through a significant correction, and that could last a while. So it could be that stocks are higher at the end of the year, but we go through a significant correction between now and then, or they could go through a significant pullback and we stay down for a year or two. It's very difficult to project that, but given where market levels are at, it's certainly much more possible now than it has been over the last decade. Valuations are likely to remain elevated near term, but again, with a significant correction potential at any time. And stocks are likely to outperform fixed income, but again, with significant caveat that a significant correction could come at any time. So I think you got kind of a 50-50 possibility on that. Stocks are likely to finish higher, but may not. With kind of a significant correction, I don't think we have a year where it just kind of goes sideways. I think it's a year where we either go forward, possibly strongly, or a year that pulls back strongly. So it's kind of a bit of a, I know it depends, but with valuations as high as they are, I think it's very difficult to project with a lot of confidence that markets are going to keep going up at this level. And I think it's significant correction could be right around the corner for us. It could be next year, but we are going to see a significant correction at some time, just because valuations are as high. And it doesn't mean to get out of the market necessarily. It means to expect it and to have the ability to withstand it and have the ability to not need to spend your money that's in stocks by liquidating them every month or whatever else. I think you need to have a certain amount of money set aside. You need to be ready for a correction that could last a couple of years. But with that, I think that's a significant possibility. Other market expectations, I think this is the year that value finally does better than growth. Value has typically done better than growth for historically, but this last market run-up since 2008 has been a growth-fueled run-up, and it continued significantly during last year, but a lot of the tremendously highly valued stocks are all growth stocks. The value stocks have done better than growth more recently. That's been very much a recent thing. But again, value is very undervalued versus growth. And I think that likely ends, particularly if we have a strong recovery from COVID later in the year. So I think that's, and certainly that's a probability too, that we have a strong recovery in the growth, in the value stocks sector. So I think that's a very likely possibility. Small stocks are likely better than big stocks. So I think they have a better year than the big stocks, and non-US is better than US stocks. That's been, and emerging markets have outperformed US stocks over time historically, but I think this is a year that international does better than US. Again, all those things could be wrong, but I think value better than growth is very, very likely. Small better than big is also very likely. Non-US better than US stocks, I think that continues as well. Just a couple other things, healthcare and financials likely outperform energy and utilities as well. That's kind of just one that's thrown in there. But anyway, that's kind of, I think, the overall presentation. If you've got questions that you want answered in some sense or in some other way, you're welcome to contact me in some other area. And I know Brian has the ability to get in touch with me in one form or another. But with that, thank you all very much for listening. I very much appreciated the time and the opportunity to talk to you, and wish you the best. Thanks.
Thank you, Daniel WIldermuth, for your talk today. Thank you for your insight and knowledge on the markets. And we thank you for your time you've given our clients and the people that are listening, whoever they may be, our clients or prospective clients. At Acres Financial Group, we've known Daniel WIldermuth since 2001 is when we first met him. And we got to decide to actually use him as our private money manager for our clients since February of 2006. February 2006, which would be February 16th, which actually is next week as we recorded this live, February 11th. February the 16th will mark the 15th anniversary of Acres Financial Group. Acres Financial Group chose to work with Daniel WIldermuth and Kalos Capital and Kalos Management since that time. Kalos Capital has been our broker-dealer, which provides compliance and broker-dealer services to us and to our clients. And Kalos Management is their registered investment advisory firm that we work through. Now, we are not affiliated with them. We are just, we work through them as our licenses or through their affiliations. So that is Kalos Financial, Kalos Management. Daniel WIldermuth also runs a mutual fund, an interval mutual fund, which means it has quarterly liquidations. It's called the WIldermuth Endowment Strategies Fund. Now, Daniel, we've known him for a while. We've known him since he looked like this. This was one of his first books, How to Keep and Grow Your Retirement Assets. It was an excellent book about 15 years ago, and I've used this many times. And we do have some extra copies if someone would like to read that. And about 8 years ago, Daniel came out with the book Wise Money. Wise Money is a book that was designed to teach the endowment method and endowment concepts of diversifying your portfolio into areas that might not be correlated with the markets. And that's some of the main tendencies of the Acres Financial Group way of investing and for our clients is not to have all our assets all market-based, to have it well diversified. So we thank you very much for listening today for our talk from Daniel WIldermuth. And we've been putting together our next talk. Our next talk is February the 25th. That's right. It's going to be with, you're going to see a new face. That face is Nathan McDuffie. He is one of our paraplanners, been with us almost 2 years. He's fully licensed, but he's just on his final testing of his certified financial planning designation coming up in the next couple of months. Him and Jeff Akers will be putting on a talk about making the most of e-money and how to understand the actual statements that you get in the mail. So it's a talk that's going to be very useful on how to access e-money, how to use e-money. That is something that we've been using a lot under the COVID times we've had for the last year, where we have to do many of these things virtual and digital. Sorry about that. It's funny when you got to talk to an empty crowd. We do miss meeting everybody personally. We look forward to the day, hopefully later this year, to have some seminars and some get-togethers where we do some of these things in person. These webinars have been a way for us to reach out to you and get information out that we feel is very important for you to know and to feel about what's going on. Make sure you know what is happening. Acres Financial Group, you can just give us a call anytime if you'd like to talk to one of our team of advisors about your situation, or if you'd like to refer a friend or a family member who would like some financial advice. Of course, we love people that are just like you, people that would like advice and somebody we enjoy working with. So stay tuned for our next one, be February the 25th on Thursday at 4 p.m. Jeff Akers and Nathan McDuffie will explain how to fully utilize e-money on your own. It is actually your own personal website with a secure and personalized login, and explain your statements that you also have. And this is something that we think is very, very important. Make sure that you properly register with us. If we don't have you on our normal mailing list, make sure we get your email. You can put that in the chat box down below, or you can call the office and leave your email with us, and we'll make sure we get in touch with you about how to get you this new Acres Financial cozy blanket. Very important. Kim Hay did a great job picking out a blanket that hopefully everybody can enjoy. I think that's it for this week. Thank you very much for listening, and we look forward to meeting you and seeing you throughout the year. Thanks.